Good morning and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's check what happened overnight. Global equity markets turning negative while US Treasury yields rose. That's despite little major economic news. On Wall Street, the Dow and the S&P 500 closed lower, pulling back from recent record highs, and the Nasdaq marginally positive. Most sectors on the S&P fell, with energy stocks down around 2%, but tech stocks bucked the trend led by Nvidia. Apple shares slipped on data showing sales of its iPhones in China fell in August on an annual basis, while shares in Hewlett-Packard Enterprise surged after Barclays' rating upgrade. The big banks, including Citigroup, Bank of America, JP Morgan, they weighed on the broader market, and shares in home builder KB Home were lower after posting a downbeat third quarter profit as it dealt with pricing pressure and lower margins. Shares of Ford and General Motors reversed after Morgan Stanley lowered its recommendations on the car makers. And Amgen fell after reporting mixed data on two drugs, sparking concern over heightened competition. US listed shares of BHP and Rio both finishing higher. Well, sales of new homes in the US fell 4.7% last month to 716,000, but falling mortgage rates and easing house prices are seen as likely to stimulate demand in the months ahead. In the wake of the Fed's half a percentage point rate cut last week, the average mortgage rate there on a 30-year fixed-rate mortgage has fallen to 6.09%. That's the lowest since February 2023. And US Treasury yields have climbed across the board, with the 2-year up to 3.55%, the 10-year around 5 basis points higher at 3.78. And the US dollar has bounced off a 14-month low against the euro, while the Chinese yuan also eased on doubts about the impact of a new round of stimulus for the Chinese economy. Riskier currencies, including the Aussie, which is viewed as a more liquid proxy for the yuan, has pulled back sharply, particularly on yesterday's CPI data, which showed inflation had slowed to a 3-year low, while core inflation at its lowest since early 2022. The Aussie around 1% lower at 68.2 US cents. And oil prices have slumped as concerns over supply disruptions in Libya eased, while traders question the impact of China's latest stimulus plans. Brent crude futures falling more than 2% to $73 a barrel. Copper has eased slightly. Iron ore has continued to rebound to be up around 1.8% to $97 a tonne. And gold has reached another record high, touching $2,670 an ounce. Bitcoin, meanwhile, is trading around 63,000 US dollars. All right, let's get across what is moving those markets at the moment. Ira Epstein joining us from Linn Associates. Ira, good to catch up with you again as we do, on a weekly basis. And how do you view markets at the moment? I was just talking there about that Chinese stimulus, which certainly added some impetus to markets in the past couple of days.
Yeah, it did. It was a bazooka attack, as it should be. They'll probably have to do more than that. But the whole idea that what this is doing is they're trying to rebuild consumer confidence. China's goal is to look inward and have the consumers, as in America, be their main driving force. Well, the property market there needs to come out of the slump for that to happen, and it's not doing it just yet. So these moves, they're early. The markets there rallied on it. What was it, 6 days in a row up in the CSI? So that was good. Copper market's probably ahead of itself here at $4.50. That's just too much a pound as I'm viewing it right now. Silver market probably got a little ahead of itself too. So the markets that bumped on this, the energies, well, they gave back a heck of a lot today, and that bothers me. We have a Cat 4 hurricane in the United States, about to hit us probably tomorrow or the day after, no later than that, probably no later than tomorrow, actually. And when that comes in, a Cat 4 hasn't hit that region in a long time. The market's either saying it's going to miss the platforms, which is very possible, and the refineries, and just stay in the northern part, the panhandle of Florida, which is going to get hit, and we'll see. So, but when I get all that bull information or a market pulls back very quickly in a Cat 4 hurricane, it has me scratching my head going, wait a minute here, is it really that bullish, or we still have too much supply on the market? Because at the same time, the API numbers in America and the EIA showed reduction. So in that not that friendly. I'll wait. Gold, I have been with you how long and saying to you, I think gold's where everybody's missing the boat and it's going to go. And here you are at an all-time high. So I feel good about that. And the break in September in stock indices is not taking place. When you get seasonals and they don't work, it is a sign that something else is taking place. And that's a lot of bullishness in the stock market. So do I think we're going to get a big break? I do not. Did I? I absolutely did. Do I think the market will now try to bottom by October 10th? Yep. Now, bottom is in terms of momentum on the seasonals. And at that point, you get a bit of a tendency to bottom out. You got to be careful with the November 5th election because markets like to break in front of that. They get a bit of a rally afterwards and then a pullback, and then the Santa Claus rally comes in. So it's Santa Powell going to make this move. We're going to have it. We're going to have rate cuts, whether they're 50 basis points or 25. They're coming. Europe's is coming. China is doing everything they can to stimulate their economy. How can you be bearish anything?
Yeah, indeed. Well, you mentioned Santa Powell. Speaking of which, he's going to be speaking tomorrow, your time.
Right.
What do you think we're going to hear? Because we've actually heard a raft of Fed speakers, largely backing up that move of 50 basis points, although a couple of outliers there. We were listening to Michelle Bowman yesterday, who has some reservations.
Yeah, I did too. I really thought 25 was more appropriate. And at this meeting, they could have gone to 50, but does it really matter? They front loaded it. They didn't go in July, so he went for two of them at the last meeting. I understand that there was no wrong speculation on it. The market was going to do what it was going to do, and it rallied into it. And it's so typical. You buy the rumor, you sell the fact, and if you've watched yields since that came out, they have been actually going up. The futures have been going down and the yields have climbed up, not dramatically, but 20 basis points, quarter of a point in some of the shorter instruments. I see that, and that's okay. So I think what he's going to say is that he's still concerned about labor. We're going to get the jobless claims tomorrow early in the morning before he speaks. So we'll see what he says. The last pair of them still showed strength in the market. We're expecting to see them climb a little bit at this point, but it's consumer confidence that is waning, and people have to watch that. It's like China's problem is consumer confidence. The American consumer confidence numbers this week plunged. That isn't a good sign. Once you get that plunging, people pull back on things. So the idea here is to get ahead of the curve by cutting rates, and away you go. And I think you're going to have meeting upon meeting the rest of this year. We're going to get a rate cut, be it 50 or 25 points. I doubt they'll go more than 125 points by the year end. They've already done 50 of them, but it's possible. But I'm in the camp of rate cuts, and that's where you're going to see this market go right now.
Ira, you mentioned those consumer confidence numbers which plunged, and the standout there was particularly in relation to jobs. Americans are very concerned that the jobs market is going to weaken further.
Absolutely, and isn't that what the Fed said? So the data is showing that, again, when you lose confidence, we've seen that in the producer prices. We've seen that confidence has fallen in manufacturing, and when that occurs, you're not hiring. And what is going on now is we're now seeing the consumer do that. So it becomes a nasty spiral. And in order to get out of it, which China didn't do right, you move ahead of the curve and you start making interest rates low enough that things start moving, just because the debt load just on the amount you're paying comes down. And that is the Fed's goal right now. They only have two mandates. It's dropping inflation and a stable labor market. They'll get very aggressive if one of these reports between now and year end comes in at 4.5% unemployment. They can live with a creep of say a tenth or so, but 4.5% will get spooky for them, and they'll address it very quickly. So far, they've done a wonderful job of addressing all this.
Ira, you mentioned some of those risks that are coming up, of course, not the least being the November 5th election. But of course, prior to that, we're back into earnings season again. More broadly, what are your expectations?
Well, we've been prepped that the market's going to see companies come in with lower earnings. Depends on the company. All right, and that becomes the big issue. We have a port strike that can happen in the U.S. starting on September 30th. We have a Boeing strike going on right now, as you know. We've seen downgrades in U.S. auto manufacturers by Morgan Stanley. They came out and they're all down. Rivian down pretty good on top of that. The one standout has been Tesla, right? It is now. I laugh when I hear this, Andrew. They're all excited about Tesla because it's no longer down for the year. You heard what I said. The stock market's up 20%. And they're excited that Tesla's not lower for the year. I laugh at those things. But what I think we've got here is a market that is going to live on earnings, earnings, earnings. I think that you've been prepped that they may not be the best in the last quarter, but I'm not too worried about that. As long as tech stays strong, which it is right now, that's your leadership role. Don't buy into this idea that it is time to rush out and buy the small caps. Not yet. I'm not in that camp at all. I think you buy the strength in a bull market. You don't buy the market you're playing for the catch up. Go with the strength, because there's always a misstep along the way. Always. That doesn't change.
Ira, thanks for joining us from Linn Associates.
Thanks for having me.
A quick look at where we're likely to begin when we get going in a couple of minutes' time. SPY futures are up, expecting, pointing about a 1/5% rise when we get underway, and we'll get right across that when we start on the open in just a couple of minutes.